Hey everybody, Signet here with the Bullish Bears. So, welcome back to another video on TVO. As you can see on my chart here, I've got the four major futures markets that we like to watch, and whether you're trading the ES or you're trading the NASDAQ, keeping an eye on all four of these is a really great way to do business when you're trying to trade in the futures markets. More often than not, one of them will be a leader. Now, the reason I'm doing this video this morning is the Russell, which is normally the one dragging its feet and weighing us down, is actually the one leading the charge this morning. So it's a great way to signal a trade entry into the market. If you are not yet in a trade and you're looking to get into one, you can identify a potential entry based on the patterns that you see within all four of these markets. Now, if you've watched the videos that I've done previously on trading the futures, we want to know and take a look at where did we come from and where are we going on a major time frame. When it comes to the NASDAQ, that is my indicator. Some people look at the stochastics, the RSI, the MACD. I literally look at the NASDAQ as an indicator. Where did we come from? We came from the 50. We are going to the 75. Now, to get there, we're going to take some twists and turns along the way. It's going to break higher, then fade back, and it's going to move in concert with the rest of these markets. Now, I want you to see what the Dow is doing this morning. It's not breaking out. This morning, the Dow is actually acting more like the Russell, and the Russell's acting more like the Dow. Now, that doesn't mean that we can't get some trade opportunities. It just means that instead of keeping our eye on the leader from the Dow position, we're actually watching for a leader in the Russell. Notice that the NASDAQ, the ES, and the Russell are all breaking out of this overnight consolidation to the upside, and the Dow is not. It's just range bound. It's really stuck in here, and it's not a surprise that the Boeing news on their latest jet issues is really weighing them down. And then you've got Walgreens, Caterpillar, the list goes on. These are the biggest names in the industry, the top 30. And if one of them are suffering, the Dow suffers. If multiple markets in the Dow are suffering, then it really just gets hammered down. So it's not that we want to ignore the Dow. It's the idea that we are not going to see a market moving in concert until the Dow starts to play along. Again, that doesn't mean we can't take a trade though. All right, so what I'm looking for here is I'm looking for the ES, the Russell, and the NASDAQ to all break to a new high at the same time, to all find support at the same time. They'll have the same flag, they'll have the same wedge, they'll have the same breakout. This gives you confluence to take your trade. Now remember, we're not trying to hit a ballpark home run, right? We're just trying to get a couple points throughout the trading session. A few points here, a few points there. To go for a larger trade would mean that we need to set a larger stop or give price more room to run. There's nothing wrong with any of that, right? But you got to be aware of various economic events that can come into play throughout the day, including the opening or the closing of different markets throughout the world. So I'm going to jump over to a regular chart. Here is the NASDAQ on a 5-minute time frame, and I'm going to zoom out for a moment and then begin zooming in. What do you see here? USA PMI numbers, the Swiss Open. We've got the European PMI numbers, Hong Kong extended hours trading, Tokyo closed, London's day session, Hong Kong afternoon session, lunchtime in Hong Kong, China GDP and jobless claims. Look at how the market reacted when those numbers came out. All right, all of these events throughout the world affect our marketplace. So if you're getting ready to get into a trade, it's a really good idea to have a understanding of what could affect your position. Now, we're overall bullish in the market. So another thing that you want to identify is yesterday's high, yesterday's low, yesterday's close, a 5-day pivot. All of these things can give you a warning or a heads up about where price could get tangled or hung up. Now you can see we're above all of that. So that's not really an issue, right? We can't look 5 days back and see any pivot points, but we can start stepping out to a higher time frame, continuously looking left for something to run into. And you can see there's nothing there. We're in no man's land. We are absolutely sitting in a whole new world. Okay, so right now, there really is nothing there to concern us. But we would want to look and make sure that there's nothing there. Now we've got a fade going on right now, back towards this spot, looking like we could potentially see an entry into the marketplace. You can see that we've came down to the spot line, and this offers us an opportunity to go long. What I don't like is this extreme spike here and the move back down. It did set a new high, and we've got our higher lows so far, but it's a little concerning that it didn't at least close up here with a new high. It doesn't mean we can't take a trade. Just want to have some perspective. You can see it's falling through. That's okay. I'd rather wait. I'd rather get the opportunity to get a great entry, and patience really is critical. I know that it's really exciting at first when you're trading futures to think that you can trade in and out with no PDT, and if you've been trading with that restriction for so long, it just feels liberating to be able to get in and out of the market as much as you want. But that's not what we want to do. Every time we take a trade, we are inviting risk. We never know what could happen. A tweet, an economic event, anything could come along and wipe out our position. So we want to wait. Notice that the price pulled back to support on the ES, pulled back to support on the Russell, pulled back to support on the NQ. So we've got confluence along all three of those, and the Dow did not drop too hard. I don't care that it pulled back to support also, but what I did want to see is that it didn't continue to pull back, weighing us down. I'm willing to go long here at the 66. So I've got my order placed there, and I'd like to see an entry, which, if you didn't just hear that noise, was me getting filled at the 66. So here's my account. You can see that my order got filled. I'm now long the 66. We need to put a disaster stop in place. 65 would kind of give me an indication that it's not going to continue up. I want to give it room because it's the NASDAQ, so at least 63.5 gives the market some room to run. So we'll just call it 63. So we'll go down here and put a stop at the 63. That's still a little close for the NASDAQ. And we could go down to 62, right? It's not the idea that we're trying to limit our risk in the trade so much as we want to protect ourselves from a tweet or some kind of economic news that could spike the market one direction or another. And to kind of gauge how far away from price we should be while also protecting ourselves, we want to look at what would prove our theory wrong. Like right now, I took a long position. I'm expecting this to rally up off of the 66. If it breaks this support level, I might consider the idea that I'm wrong. If it was to break this level, I would really consider the idea that I'm wrong. Okay. Either one of those would perhaps make me think that either I got in too soon and it's not yet ready to rally higher, or that I'm just wrong and it's coming down while I'm looking to go up. And I would want to exit my trade. I wouldn't want to wait for price to come all the way down and hit my stop. That stop is only to protect me from a tweet or from news. Okay, so either one of these decisions would be my choice to leave this market and just to acknowledge that, hey, I'm wrong, right? There's nothing wrong with being wrong. We're only trying to uh, guesstimate what we believe the market's going to do. If we have a plan and the market doesn't follow that plan, just acknowledge it, close the trade, and form a new plan and look to get back in again. Don't hang on to a loser thinking that, well, it's gonna come back around, because it might, but it might not come back around before you have to exit the trade at the end of the day. It might just continue to fall and fall and fall, and at that point it's going to be such a loss that it's stomach wrenching and painful. We don't want that. Just acknowledge that what you believe is wrong and close the trade. If it turns right back around and continues to do what you thought it was going to do in the first place, jump back in. All right? Don't punish yourself or doubt yourself or get down on yourself from this idea that, well, I thought it was going to do this and it didn't, and then I exited it, and then it did do what I thought it was going to do, and now I'm wrong. And don't get hung up on all of the emotion and the turmoil and the self-battering. Just acknowledge that you perhaps got in too soon and you exited the trade, but your opportunity is still there because your bias is still solid. Take the trade. And this is something that we all have to work on. Our pride and our instinct and our need to be right interferes with our logic, interferes with the idea that we need to stay consistent, not to revenge trade, not to uh, add to our risk just to prove that we were right, and let the market do what it's going to do. Remember, it doesn't have to do anything. And all we can do is try to limit our risk in the trade and stick to the rules. So I want to thank you for watching this video. I appreciate it. I hope this gives you a little bit of perspective, and I look forward to seeing you at the next one.